Okay, we're live. Okay, we are live. Let's see, what time is it? It's 7:07. So we'll give people a couple minutes to log on, and then we'll just do a brief intro, and then we'll just get into some topics.
That's good to me.
If you see me doing something here, don't get distracted. And what you see on the screen is going to go away in a couple minutes. But I'd like people to see your contact information when they log on. Let's see, do we have anybody? Okay, well, we're going to get started on episode 7 of Tuesdays with Terry. This half hour of real estate on the internet. Tonight, we're thankful to have Danny Poulos with us. Danny is the senior loan officer for the elite lending team at Milestone Mortgage. He was the 2017 Educator of the Year, and I've taken several of his classes. They're very good. 2014 Business Partner of the Year, 2015, 2017. Board of Governors of the Realtors Association of Palm Beach, and also the Realtors Association of Jupiter Tequesta Hope Sound, which is also with Miami now. Danny's been in the business for 30 years. He's also a nationally recognized marketing expert. He came up with the Ninja marketing program, which is very popular and used by a lot of realtors. And you can often see him in the media, on TV, even on national TV. He gets called upon to comment on real estate lending issues nationally, locally. He's also a music aficionado. He sings and plays the guitar in the duo. You still with Acoustic Kool-Aid?
Yeah, we get together now and then.
Yeah, you can find him sometimes in the up in the Jupiter, Palm Beach Gardens, Tequesta area. And he has a massive music collection, which is probably behind you as we're speaking.
Some of it.
Just some of it, huh? Well, thanks for joining us tonight, Danny.
My pleasure, Terry.
I've worked on transactions before. He's a great guy to work with. Let's talk a little bit about the new lending requirements. I know things have changed with the COVID-19 pandemic. You want to tell us a little bit about what's new now?
Yeah, there's been a lot of changes. I mean, it really has just come down to banks being concerned that they don't know if people are going to be having a problem making their payments. If their employment is secure, if they went back to work, how long were they off of work? Are they going to be back off of work again? Self-employed people, especially, they're concerned about how this is going to affect somebody's business. So not just looking at historically what they've earned for the last 2 years or year to date like we would normally do, but now they're really looking at what's going on in the last 2 months. And it's made things a little tricky, especially for self-employed borrowers.
Well, there's a lot of self-employed borrowers out here.
It's true. And even in the non-conventional lending field where they're looking at gross deposits to qualify somebody, that's been an issue for a lot of businesses in the last couple of months is their gross deposits. So I can give you a perfect example of a problem. Traditionally, we would look at, for a self-employed borrower, we would look at their last 2 years' tax returns. We'd calculate their income based on that, and then we would get an unaudited year-to-date for this year just to make sure that it sort of matches up with the income we're using. What you're really looking for is just to make sure there isn't a big decline in income. but it's not audited, it's not filed. It's just a business owner showing that, he's on kilter with what he had been doing previous years. Well, some lenders now, and I'm going to say that a lot, some lenders, because these are all credit overlays that individual lenders are putting on their products. They're not changes in Fannie Mae guidelines or FHA guidelines. Those are remain pretty much unchanged. These are things that lenders are putting on top of the regular guidelines. So I may say something is restricted. Well, it may be restricted at one lender, but not restricted at another. So from the wholesale side, me being a broker, I'm looking at, 10 different sets of guidelines now instead of one. So back to the example, a lot of lenders are looking at that year to date that we didn't pay that much attention to before and matching it up with the last 3 months business bank statements to show that the revenue is really there that goes with the year-to-date income. And if it's not there, they're getting sort of intricate, looking for, contracts that may be receivables that are due. So they're really getting picky. Understandably, I guess, if you're in a business that's likely to be affected by this and the lender doesn't know how long you're going to be affected, so they have concerns.
Well, especially for self-employed, income has probably dropped off drastically in the last 2-3 months. And, we may be faced with another shutdown.
Yeah, but, not all businesses. Some are thriving and doing great. So if it's not reflected in the documentation that there's been a decline in revenue, then it's not really an issue. But you're right, a lot of people have been affected.
Well, explain a little bit the difference between you're a mortgage broker,
right,
in a bank. So a bank has certain.
It would be the same as if I worked for 10 banks at once, right? Because each bank has its own guidelines and their own, guidelines on the kind of risk they want to take and the risk aversion, and they can change it at any time, right? It's their money. They're going to be servicing the loans. Well, I'm looking at the wholesale lenders. So it may be like working with 10 different banks. So they're all have their different guidelines. There are some that were very quick to tighten things up and some that were very slow to tighten things up. So it also has affected being able to quote an interest rate because you don't know what lender you're going to end up on that until you really see the whole file. So you don't know if those restrictions are going to kick in. So you want to be careful about saying, okay, here's what your rate is going to be, because you may get deep in the file and say, wait a second, this lender will only go to 75% now on that product you need. We need to be at this other lender that still goes to 80 or 85, and their rate may be a little different.
Let me ask you this. Well, let's say you have a client that comes to you and, it looks like everything is good for them and you issue a pre-approval for them to purchase a house, but, it's going to take 30 days to close. Guidelines could change in those 30 days.
Absolutely. You really have to stay on top of your files and know who may be affected by a guideline change. I've honestly had some deals that were self-employed borrowers getting ready to close, like refinances. Then a bunch of new overlays came in where they started scrutinizing bank statements, and it made some deals undoable. Not a lot, but it can happen.
I've been in my own case, I've been looking for a property for somebody in a specific area. And, what I'm seeing are some pending transactions that seem to be pending for quite a while.
Right.
It makes me think that what you just said, maybe some new overlays came down and maybe the initial financing isn't going to work out and they're scrambling to try and put the deal together.
Yeah, I mean, you shouldn't be nervous about every deal, but if you know that a deal is tight at the beginning, you just want to keep an eye on it and make sure that nothing go sideways.
And get it closed as soon as you can.
Without question, and with closing timing, you probably need to add, a couple extra days on now for if the underwriter comes back with any kind of COVID reassurances that they want. I'll give you one that I just saw the other day, is they want the last 3 months of mortgage statements so that they know that the day of closing that all mortgages are current. So they're just making sure that someone's not about to have a problem. So the credit report may have only reported up to 2 months ago on the mortgage. And in their final underwriting conditions, they said they wanted the next 2 months mortgage statements to know that those payments were made. Is the last thing they wanted to do was all of a sudden be closing a loan and it comes up that the person was about to go 2 months behind on their mortgage.
Well, how about, a lot of people have taken the mortgage forbearance for the last couple months. If you were in the process of selling your house, but you're getting a forbearance, does that affect the transaction, or will that all even out in the closing documents?
It's really been affecting just refinances.
Okay.
Because if you've been in forbearance and now you haven't made payments for 3 months, you may have a problem refinancing without having made payments in 3 months. Don't use that as set in stone, though. There are some lenders that are saying if you can prove you were in forbearance and now you've made you're back on making payments, or you've caught up and you're back on making payments, they might not let you wait. But when they first came out with the forbearance, the restrictions for refinances came out right away, and then they started backing off some.
Well, I know I saw things online and on Facebook and stuff about people who took forbearance, but their lenders were not spreading the payments out. But when the forbearance ended,
That's right,
everything was due. And you might see yourself with a $9,000 payment due on the
absolutely. I mean, you can imagine the number of calls I had on that with people getting paperwork. What do I do with the forbearance? And I had the same advice for everybody. If you don't need to do it, if it's not an emergency situation, don't do it. It's not like there's any advantage to putting off payments. So if you don't need to and you can make the payments, make the payments. And then if you find yourself in a position where you just can't make that, then read the paperwork carefully. And we read a lot of people's paperwork for them, and figure out what's going to happen when your forbearance is over and what your options are going to be, so you don't get yourself in a bigger jam than you're in already.
Yeah, unfortunately, the lenders aren't always there to really help you out.
Yeah.
A for-profit business.
Yeah, well, it makes sense to make sure you're in touch. Don't ignore anything and be in communication. They don't want you going behind either.
Oh yeah, absolutely, absolutely.
Some of the other things you asked me about that have changed is some lenders are restricting debt ratios. So they're not going as high as they could before. Some are looking not to go over 43% at high loan to values, even though, through desktop underwriting, you can go considerably higher, up to 50 in some cases. But some lenders are saying even if it can get approved, they don't want to go above 43. There's other situations where you can't go above 50, where exceptions can be made to go above 50 before. And probably the thing that's affecting the most people is the raise in minimum credit score requirements. So FHA, where before we could go down to 580, that's what FHA would accept, even though a lot of banks still wanted 620 or 640 before. FHA would accept 580 on a 3.5% down loan. So that's what we used to do. Now, not the case. There's very few lenders now that will even go down to 620 on an FHA, and most of them 640. So, and same thing with conventional. They're looking for higher credit scores than were required before. So you need to be careful about files that you may have pre-approved a while ago, and now you're getting ready to send people out to look at houses. Run the file again and make sure it still approves, or you may have to switch lenders. If the lender that you were planning on directing the file to has excessive overlays and the file's not going to work there anymore.
Oh, you're kind of painting a bleak picture for getting a loan right now. Are there any bright spots? What about is it basically that people that are on the lower end, closer to the 580, would be better to try and improve their credit score?
Yeah, I mean, honestly, they've just got to wait at this point, because even the non-prime loans aren't going down to lower credit scores. So you're right. They should take the time to work on their scores. Nobody expects that these restrictions are permanent, right? But nobody also knows how long it's going to go. Another area you got to be careful in also is in investment properties.
Okay, yeah.
Maximum loan to values have been reduced. Fannie Mae used to go to 85. Hard to find a lender that'll still go to 80. But more importantly, a lot of lenders are not letting you use the potential rental income to help you qualify for the purchase.
Well, that makes it difficult.
Yeah, it makes it a little difficult because you expect that you're going to be able to use 75% of the projected rental income to offset the payment. Some lenders are not letting you use it. You got to qualify on your own income that you have already.
So are you seeing
you just have to be careful and know the guideline at the lender you're working with.
are you seeing a slowdown in investment lending due to that?
Most of the investment buyers aren't that tight in what they're trying to do. You know, they're pretty savvy about how to finance. So this is not a big shakeup for them. But if it was somebody just trying to start out, maybe with their first property, needs that rental income to make it work, they may just have to wait a while, or the larger down payment.
Yeah.
There's still those cash flow loans that ignore the your personal debt and your personal income and just look at the cash flow on the property. Those I think of now have a 30% minimum down payment.
Ooh.
So if you've got 30% down, though, you're pretty good on investment property, because in this market, the rental will cover a mortgage on 70% of the value. So that's sort of a no-brainer. That product's still out there.
Okay. Well, you know, as we're talking about changes, I don't think this change is really related to the pandemic, but recently I read about an easing of restrictions on lending for condos. And
yeah, that's last October. You could begin to do spot FHA approvals using FHA. I mean, condos using FHA financing. So in the same way that on a conventional loan, you can do 3% down or 5% down on a condo, as long as you have adequate insurance, you get that condo questionnaire filled out, adequate reserves. Basically the same guidelines now can be used to do FHA financing. So it's really opened up a lot of doors for first-time home buyers that couldn't afford single-family home prices and could only afford the condo prices, but were cut out because FHA wasn't approving condos. So
yeah, you had to, you know, they would put out a I think HUD or FHA would put out a list
yeah,
of approved condos, and it seemed to me that the only ones that really had the financial ability to meet the requirements were upper price condos. Like,
Yeah, it's not only that, it's that the associations weren't bothering to go through that process to get the whole project approved FHA. You're right. So that was the obstacle. Now that you can do it just like conventional, you just do it per unit.
well,
The only thing I can tell you is give yourself some extra time because FHA is a little slow in approving the condos, a lot slower than the conventional approval process.
are they? So you're thinking that's like 45 days,
I'd go 60.
60?
Uh-huh.
Well, one of the things I learned last year when I was helping a couple people find condos, I hadn't done a lot of condo sales, mostly done, single family detached, is that some of the big condo developments, they went to individual building condo associations. And each little condo association had its own rules and restrictions.
Yeah, sure.
Many of them were requiring 20 to 25% down. Doesn't matter what type of loan you had, they wanted you to have 20 to 25% down.
Yeah, that's another story.
Well, that knocks some. I mean, even though you're talking about, especially for a first-time home buyer, maybe $150,000 unit, still from 3.5% to 20% down is a big difference.
Yeah.
We got about 10 more minutes left here. Let's see, we went over investment properties. Do you have any predictions for the housing market and the mortgage industry going forward here? I know everything's so unpredictable.
Knock on wood, things haven't slowed down for me personally at all. And I know there's a lot of realtors that are real busy out there.
Yep.
And I don't know if this is true, but I think that people haven't been stuck in their house has made them think, I wish I had this. I wish I had that. I wish I had a bigger patio. I wish I had a pool. Boy, it would be nice to have another bedroom. And they're really thinking about home buying while they're sitting around in their homes.
Yeah, I've heard that story, and you're right. There are a lot of people moving a lot of properties. Some of those are the younger people in the business. I know, just for me and my family, we had some risk factors. So I wasn't, I wasn't actually going out and showing any property.
Right.
I wasn't going out much.
Sure.
So, I was more in a high risk category, but it's tough. Some people are, some of the younger realtors and some of the younger buyers are a lot more tech savvy.
Right.
I mean, this is your first Zoom, for crying out loud. Some of these,
I'm camera shy.
some of these younger realtors, though, they're really tuned into the millennials and
Right, and they're used to watching things on video and
I mean, it's hard to believe
then everything being
buy
hands
a
on
house without ever setting foot into it.
Yeah.
But they're doing it.
Yeah, I could
change the whole game from here on out. I mean, we're doing everything on Facebook and on Zoom. You don't necessarily have to come to the office anymore for anything. Closings are almost virtual now. So, this pandemic has moved us ahead.
Yeah, well, from our side, it's been years, since it was standard to sit down and meet with someone to do an application. Everything now is started online, and then you're collecting documentation. There's a lot of communication, but the days of, sitting down and filling out paperwork are long gone. So hasn't been a big change for us.
Well, that's true. It's been a little bit of a change for us in that we were in real estate, as a realtor, you were taught, and you wanted to have people come in and sit down and have a conversation,
Sure.
because you want to get to know each other. You want to know, is this going to work? And you kind of want to dig deeper into what do they really want.
Absolutely.
And, let's take this opportunity to look at some things, on MLS. But now we found out that that's not necessary.
Yeah, well, that's when MLS was a big book like this, and you had to flip through the pages.
That's right. How outdated was that information by the time you got there? Now, and you had to go to the office to pick up the key to show the property.
Right.
Now, everything's on Supra.
I'd say the one thing that hasn't changed though, and probably has become even more important now from the lending side, because you may think everything's fine, and you go out and start looking at properties. Now it's even more important to get a pre-approval, because the seller's going to want to see that. The seller knows things are tightening up, and the selling agent is bound to ask, how old is this pre-approval?
Yep.
Because they know if it's from 2 months ago, it may not be worth anything today. And I can tell you, on almost every deal now, I get a call from the selling agent, from the listing agent, when they see the pre-approval letter, wanting to know when I last checked everything.
Yep.
Do they still meet all the guidelines? Because, realtors are smart. They don't want to take a property off the market based on an approval that isn't good anymore.
No. And I looked up 3 properties this morning to schedule showings, which would have basically been a virtual showing, but all 3 wanted to see the pre-approval letter and have it in their hand before they would even schedule a showing at the house. Oh, we lost Danny. He's frozen up. Well, we're going to try and get Danny back here. He froze up, and just give us a second here while we're good.
He's gone.
He's gone. Okay. We lost Danny. So we were about to wrap this up anyway. So thanks for joining us on Tuesdays with Terry. Feel free to give me a call at any time. 561-340-9623, or you can email me at reed, R-E-E-D, group, G-R-O-U-P, at kw.com, or you can go on the Facebook page that you're watching this on now, and you can just book a consultation, a free consultation, right online. And I just want to give you Danny's contact information one more time. His number is 561-373-4149. And he is the senior lender for the elite lending team at Milestone Mortgage. They are located in Jupiter, but they loan everywhere in the state. As you heard him say, everything's online now. Loan applications are online. So if we can be of any help, either one of us, please contact us. And just to let you know that this is episode 7. So the 6 previous episodes of Tuesdays with Terry are also available on the Facebook site, or send us a message and we'll send you the link to all 7 episodes. And next weekend, hopefully we'll have another guest on another topic related to real estate. And thank you, everyone, and have a great night.